Investors have been waiting for years for a rally in small and microcap stocks that just hasn't been coming.
Each time we get an economic data point that leads, investors to think that there's going to be a rate cut, small caps will broadly rally, but then falter. Just for frame of reference, if we just look back over the last 3 years, at the start of 2023, the Russell 2000 was expected to grow earnings 8%. They declined 10%.
That's Conrad Doenges, Chief Investment Officer at Ranger Investment Management. And in the market call today, he's talking small and microcaps and why they have a legitimate catalyst to do better going forward. But before we get there, Jeffrey Patak, Managing Director at Morningstar Research Services, is here looking at the piece he wrote last week talking about why popular funds often lead to disappointing results. Plus, Allison Hadley, analyst at Digital Third Coast, is here discussing the mid-year tariff survey that she conducted for bidonequipment.com, which shows that Americans are changing their financial habits even if they don't fully understand why they're changing their habits and what would be the right moves to make.
Gentlemen, start your engines.
Welcome to Money Life for September the 9th. I'm your host, Chuck Jaffe, and yes, I'm on the road. I am visiting with my new grandson. We did this entire show and yesterday's show all in advance. The interviews are mostly done, maybe completely done for tomorrow's show. That'll depend on what happens as I will be leaving today, cross country today, to get to FinCon. And by the way, if it weren't for my grandson, I probably would have been at Future Proof out in California, just spent the whole week on the West Coast. But this is a lot better, I am sure. I'll tell you about it tomorrow. I made sure I didn't tape everything because I didn't want you to go too far into the week and go, wait, he didn't say anything about his grandson? So as I record this, we're getting ready to leave, and I am super excited. I cannot wait. So you'll get to hear that excitement, hopefully, as it manifests when you hear me on tomorrow's show. But we've got a great show to get to right now. And the research done by Jeff Patak at Morningstar, it's not a surprise that funds that get immensely popular have problems, generally speaking. The interesting side there, since we had David Giroux on the show yesterday, is that I don't think David Giroux, for all of his success, actually would qualify, and his fund would be the exception to the rule. And I think the bigger thing is that his fund, while it has done very well, has not had skyrocketing performance, right? It has not had the kind of performance that makes everybody go, that, I need to go buy that, as opposed to, say, Kathy Wood from the ARK funds, who are kind of the poster child for, wow, the money's flooding in. I'm so surprised to learn this, but it might be something you want to keep in the back of your head the next time you hear about a fund and you think, oh, I got to get in on this. The interesting thing about the tariff survey, the real reason I wanted to talk to Allison Hadley about this one, is that they did a survey at the beginning of the year, before Liberation Day, and found that people were starting to make changes to their habits, even though at that point they could have had no clue of what was coming. But as you'll hear me say, if you told me right now, stockpile things before the tariffs get worse, I'm not sure I would know what to stockpile. Of my day-to-day expenses and things along those lines, I'm not sure that I know, oh, let's go get this or that. You'll save a bunch of money down the line. So I don't know whether people are reacting just to feel good, but that's part of what we'll talk about with Allison. I'm Chuck Jaffe, financial columnist, your host here on Money Life. Because I taped everything early, I'm not going to try to buffalo you with whatever's going on or trying to do something off of current events. Well, if something happens on the market today, we will talk on. You know what you're expecting here, and we've got another show for it today. But write me, chuck@moneylifeshow.com. I would love to hear from you. Right now, I'd love for you to hear from our guests. Again, they are Jeffrey Patak from Morningstar, Allison Hadley talking about tariffs, and Conrad Doenges from Ranger Investment Management here with the Market Call. We're going off the news right after this message.
Everything an advisor needs can be found in one award-winning newsletter. Advisor Perspectives takes the most important financial perspectives and delivers it right to your inbox. Go to advisorperspectives.com and stay informed.
Welcome back to Money Life, where we are going off the news. And the news is a very specific story that, as a mutual fund investor, you should be particularly interested in. Because I'm joined right now by Jeff Patak. Jeffrey Patak is managing director at Morningstar Research Services. If you want to learn more, of course, it's at morningstar.com. But the story we're talking about is his, based on his research, and it's headlined, "Your Fund Crushed. Investors Love It." Uh-oh. Because, yeah, as a fund becomes popular, well, we understand it can lead to disappointment. It's an old story, but there are some new twists in the research. Again, if you want to find it, morningstar.com, or go look for where we mentioned Jeff in our show notes, because there's a link there. Also, you can find it where you find Jeff on the Money Life Show, recent and upcoming guest page. Jeff Patak, it's great to have you back on Money Life.
Well, thanks so much for having me. I really appreciate being back.
This is not a new story. In fact, this story is pretty much as old as time, predates Morningstar. I think it's what Morningstar was almost created to stop, was the idea that, like, hey, here's a fund. It got popular. People heard about it. Money rushed in, and then it did badly. But there is a difference here, because to some extent, the story was always, yeah, the fund does great, money rushes in, and the money does badly because, hey, things regress to the mean and things change. This is less about cycles, though there's some of that, and every bit about how does management do after they get that rush of money, isn't it?
It is, yeah. So the study that we conducted, we were focused on what you might think of as hypergrowth funds. So these are funds that have received a torrential amount of flows over a relatively brief period of time. In our study, we focused on rolling 12-month periods. And what we found, to your point, is that while performance might have been quite good before the money came in, it suffered afterwards. And we can certainly get into why that might be so. But this was focusing on the performance of the funds themselves. And what we did find was that the performance suffered.
Help us understand suffering, because you have these funds, typically their hyper growth is because they're doing hyper performance, which nobody expects to continue. So let's not worry about whether they continued the hyper performance that attracted the people. How much did they lag their benchmark or the average fund in their peer group?
Yeah, so they would have lagged. So we were looking at their performance versus broad benchmarks before and after this period of hypergrowth. And so whereas before they would have outperformed the broad market measure by 3 or 4 percentage points annually in the 3 years that preceded their hypergrowth, they lagged on average by multiple percentage points in the period after. It was the subsequent 36 months that we were measuring. And so it was a meaningful swing. The other thing that you would notice, even if it didn't lag the broad market benchmark following that period of hypergrowth, the margin by which it outperformed shrank. So if people went with an expectation that it was going to crush the benchmark by a certain amount based on how it previously performed, they would have been disappointed even in that case, because it would have outperformed by a lesser margin over that subsequent period.
From that perspective, in the old days, and I'm old enough to know what the old days were because I lived through a bunch of them, we used to have a lot of star managers. The funds that people will think about when they are thinking about your story, and then they'll find mentioned there things like Kathy Wood and the ARC funds, etc. But star managers are kind of a thing of the past. Like, it's much less about star managers. So the funds that were achieving hyper growth, how much of it was there's a personality and the personality's driving it? How much of it was there's an asset and the asset is driving it, or the investment philosophy is driving it? Because that is a big difference in what's going on. And there's no longer Money Magazine and Kiplinger's to, like, put a fund manager out front every month and create kind of accidental hypergrowth.
You're exactly right. You're correct that, back in the day, it was more often than not a star manager, someone who had achieved a certain notoriety thanks to the performance of the vehicle that they were managing. Assets rush in, performance suffers. What we found in our study is that that is not the archetype anymore. You could be talking about not just an active fund, but an index fund. And we gave a few examples in the study that we published recently. And what you would have found is that while a few of those were actively managed vehicles, several of them tracked indexes. There was a clean energy strategy. There was a lithium, as in batteries, thematic ETF that was among those that experienced hypergrowth and whose performance suffered. And so they can take a much wider variety of forms now, not just active, but passive as well.
When that happens, the story was always active managers can't keep performance up. Is there a lesson to be learned when passive strategies can't do it? Because obviously that would be some measure of regression to the mean for the asset itself. But, it also means that, again, index investing, we can all agree we love passive investing. But you still got to buy the right index.
You got it. And so in some ways it's clarifying because I think that we knew formally that some of these star managers, they probably would have been celebrated for their acumen, their skill, their stock picking prowess. But in a number of these instances, what was really happening is there might have been a modicum of those things, but they probably also were enjoying some sort of stylistic tailwind, or more pejoratively, they might have just gotten lucky. The reason I say it's clarifying is that you have none of those conflating factors when it comes to an ETF or an index fund that tracks an index. There's nobody trying to beat the market. There would be no stock picking prowess to speak of. And so in those cases, what you are talking about are stylistic tailwinds, or, it could be simple luck. You bring out an index fund at the right place and time, it catches a break, performance is good, money rushes in, and that luck runs out, subsequently explaining the topsy-turvy performance pattern.
So, is the moral of the story, if you didn't hear about it when it was small and new, or when it was not a great fund, or didn't have some track record that made it the envy of everyone, don't buy it. Like, don't rush in with the crowd, but look at something that is maybe not quite as highly rated or as high performing in the same asset class? Or is the answer, nah, don't even bother with the asset class because, again, it's going to roll up?
Yeah, so I think that if you encounter a vehicle that comes to your attention, it's enjoyed strong performance versus a broad market benchmark, and it's caught on with investors. You're seeing evidence there are many, many investors that are rushing in the assets, have risen quite dramatically. I would be wary. Those are two factors that tend to portend, I should say, underperformance, at least as we measured it in our study. And to your point, I think that, making caution the better part of valor, focusing on something that maybe hasn't achieved the same sort of notoriety, and maybe if you're a believer in mean reversion has underperformed for reasons that are understandable, that could be a worthy candidate for your portfolio, but you certainly want to diligence it, whatever it happens to be.
When it comes to these funds, if you're in it and then it hits, obviously you want to enjoy the ride. Is there a point? Like, is there the point where you go, hey, I've been at this, but it was growing big and it was doing well? Is there a point when you say, here's hyper growth? And again, you came up with a definition for it where you go, if I see hyper growth, that's my problem sign?
That's a really good question. Very astute point. I would say it depends a little bit on how the strategy is being implemented. So if it's an active strategy and they see a rush of assets, that in and of itself isn't a reason to sell, but I think that you ought to be asking yourselves questions about how well can the manager adapt to that influx of assets. We've seen time and time again, managers probably they overestimate their ability to adapt to inflows, and the fund suffers from asset bloat, performance suffers. And so I think it behooves you in a situation like that to try to ascertain whether this is the sort of strategy that can scale. Slightly different story when it comes to index funds. I think you probably want to understand why it is it's caught on and diligence that. And then also you probably want to double check your expectations. Why am I here? To what extent was it predicated on it outperforming? It has outperformed. What can I therefore expect about the future? Should I temper my expectations? What is my time horizon? Am I prepared to stick with it as long as it takes? Those are the kinds of progressions questions you probably want to run through as an investor.
And your story doesn't get into this, but your story did, of course, mention Kathy Wood. So, what kind of a sign should we take it as investors if your fund or your manager winds up with somebody else creating the inverse ETF? Because there is the anti Kathy Wood fund, if you will, the Tuttle Capital Short Innovation Fund is SARK, and it's basically let's short the ARK Innovation Fund, or let's go opposite to that. Is that a sign?
Well, so I think that shouldn't be a referendum on her abilities as a portfolio manager. She has her own particular style that she pursues. It's certainly not for everybody. I use the term hypergrowth. I think that's a fair way to characterize her investing style. And I would say that for many investors, they would find it's niche at best. They're probably their portfolio isn't going to have room for a strategy that is as aggressive as that one. I would say, though, from a certain standpoint, it means that her strategy has achieved a kind of notoriety, a kind of popularity. And what we have found more broadly, without it being a referendum on her potential as a manager, is that that does tend to be negatively correlated with future performance. The more popular you get with investors, the worse that portends for your future performance. And certainly that particular strategy has itself had a topsy turvy record of performance.
And the other moral of this story, the other thing that I took away from reading your piece is it's okay not to follow the crowd, or maybe to follow them into an asset class, but not into a fund. Like people who feel they have FOMO, they might miss out. Oh, I didn't get this fund, etc. No, 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 no. Don't fear that at all, because it's not a thing, is it?
Absolutely. I think that's very well said. Go the other way, if anything. Now, I shouldn't be too categorical about that because one of the things that we can observe is that, for instance, there's been a lot of money that has gone into passive funds. And I think generally speaking, we would be supportive of that. People are lowering their costs in the case of ETFs, they're burnishing their tax efficiency, hopefully consistent with their investment objectives and risk parameters. So that's not necessarily a bad thing. But I think when we're talking about strategies that are vehicles that are experiencing meteoric growth, there seems to be sort of a hubbub, a frenzy around them. I think you want to be especially wary of situations like those. Back away, give them a wide berth.
Jeff, great stuff. Always is when we get a chance to catch up. Thanks for taking the time and coming back to Money Life.
Oh, thank you so much. It's always an honor to be here.
That's Jeffrey Patak. He is managing director at Morningstar Research Services. Morningstar.com for more information. Better yet, go find the piece we were just discussing. Your fund crushed. Investors love it. Uh-oh. And you can find that by following the link in our show notes or on our guest page where you find Jeff Patak. And we're just getting started on today's edition of Money Life. So we'll take a quick break. We'll come right back to more in just a moment. Stick around.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Now Money Life looks at what the survey said. Yes, this is the survey said, where we dig into surveys, studies, polls, any kind of research or data that's going to help us understand what people are doing for, with, and about their money. And today, we're looking at what they're doing about their money because of tariffs, because we are looking at the mid-year tariff survey that was done for bidonequipment.com. And these guys had the foresight to do a tariff survey at the start of the year. Before President Trump was inaugurated, they were doing something about what people thought was going to happen with tariffs. So that gives us a little bit of perspective as well. But if you want to find out more, bid-on-equipment.com is the website. There is a direct link to the mid-year tariff survey in our show notes or on our guest page for Allison Hadley. She's an analyst at Digital Third Coast who did the work for bidonequipment.com. Allison Hadley, it's great to have you back on Money Life.
Hi, Chuck. Pleasure as always. How are you?
I am well. I'm also not one of those people who is freaked out about tariffs. Not that I like paying more, but I do kind of find it odd because, your results said that 1 in 5 Americans are stockpiling goods because they see tariff-driven price hikes. That's about double what was happening 6 months ago or, before we got the tariff news. And I'm just saying, I'm not sure I would have even known which goods to be hoarding. So did they wait until the tariffs were announced? And what are they hoarding at this point?
So we didn't specifically survey people on what objects they're hoarding because, as you mentioned, what would they hoard? Because it's very hard to tell which tariffs are hitting when. And that actually speaks to one of the statistics we collected for this that says that 1 in 10 consumers are confused by tariff updates all the time. Between rolling back timelines or announcing deals, it's very hard to track which countries actually have tariffs that will affect consumers sooner rather than later, whether it's food, whether it's metals, whether it's cars, what companies are stockpiling now. And I think that just created a general sense of anxiety. About 51% reported having anxiety around tariffs. And it's driving 1 in 5 to try and stock up on what goods they might think are about to go up in price, which is more than in January when there was just rumors that tariffs were coming down the pike.
People are changing their behaviors because of tariffs. And the basic behavior they're changing is how much, not necessarily they're spending, but how much they're buying. In other words, they're probably spending similar amounts, but they're buying less. Or are they actually cutting back because they think prices will be so much more down the line?
They're genuinely trying to cut back where they can. So 77% said that they would be changing their behavior due to tariffs. And a lot of the people who said that they were doing that, 51% said that they're just trying to reduce their spending overall. That might look like they're spending the same amount, but they're buying less, but generally they're trying to self-restrict. Another example of this is about 1 in 3 are trying to switch from, say, like known brands to store brands, right? The private label goods, because those tend to be cheaper. You see a lot more people embracing secondhand shopping. That's another 1 in 3. Other people are switching to budget grocery stores like Aldi, which tend to offer lower prices. And some people are just cutting back on buying clothes. Other people are taking more drastic measures like skipping medical care, embracing credit cards and buy now, pay later a little bit more often. And 1 in 10 have started going to food pantries to supplement their food.
That last one particularly alarming because we don't want to see more food insecurity for anyone in this country.
Absolutely. Especially with SNAP requirements coming as well.
Yeah. But the other side of this is that I don't know that you can ask Americans a question about spending and what they see happening and not have them blame tariffs. In other words, if you look in your grocery store, you may not be aware, did your grapes come from Chile or did you import something from some other country as you were doing it or whatever it might be? Where did your produce come from? But I don't think that folks look at the price of potatoes, see potatoes going up, and I think they're still blaming it on tariffs rather than what's going on in Idaho. So how do we get by this? Like, do we have any real impact? Do we have any way that they can separate what their suspicions are from reality?
So I think if you look at the data, right, 81% report that they've noticed that prices have increased since January. But when you look at the top categories where prices have gone up, it's things like food, health and personal care. Then you see things like clothing, tech, home essentials like your toilet paper, your cleaning supplies, etc., right? And with that, you see that people are blaming tariffs, even though those aren't necessarily the things that tariffs would hit right now. Like maybe food, but past that, the other things, healthcare, that necessarily won't be a tariff related thing. So I would say that it's important to really consider how the tariffs are being communicated to the people and actually paying attention to what those details are to understand what goods might be worth stocking up on now.
Yeah, I don't mind people blaming the tariffs. That's fine if that's what you want to do. But the problem is if you're blaming the tariffs, again, your study suggested that more than 80% of people are noticing higher prices and most blame tariffs, but you're changing your habits. Whatever habits you're changing, probably not that impactful, and certainly not impactful when you're stockpiling stuff because you're blaming the tariffs for everything. You're stockpiling stuff, but you got no clue.
Yeah, I mean, in many ways, it feels like the urge to stockpile that happened in 2020 when people were stressed about it and they just manifested it by consuming, right? And I think that right now, in the same way, there's a lot of anxiety around cost of living, and people are manifesting that by blaming tariffs because it's what's been communicated a lot. And also, they see prices go up, so it's very easy to add the two. I think it's really interesting that 93% reported that they were following tariffs at least somewhat closely. That's the majority of Americans, right? But 40% were frequently confused by tariff updates, and 11% are confused all the time. And when you ask, the average consumer what they think tariffs are going to do to prices, they said that it would have an average price increase of about 11%. So there's this clear anxiety that they see that tariffs are here or are coming, depending upon which tariffs, and they know that that will probably result in price increases. And there's just this impulse of something's got to give. And I think it's very easy to stockpile or just sort of cast blame on tariffs. We surveyed consumers, and about 66% said that they opposed tariffs. 16% said that they were in favor of it, and 18% were tariff neutral. But that also speaks to the fact that there's a lot that's going on in the head of the average American trying to figure out how to navigate this tricky economy.
Yeah, there certainly is a whole bunch. Some of it probably right minded, some of it not so right minded, but not necessarily the worst thing. I mean, if you're stockpiling at reasonable prices, there are worse things than that you could do to yourself financially. Allison, interesting stuff. As always, I'm sure we'll talk with you again soon. Thanks for joining me.
Thank you, Chuck. Pleasure as always.
That's Allison Hadley. She's an analyst at Digital Third Coast. She did this study for bidonequipment.com, bid-on-equipment.com. There's a direct link to the mid-year tariff survey on our show notes and on our guest page. And there's no tax for listening to Money Life. So settle back, relax. We'll be the same price when we come back right after this message. Conrad Doenges, Chief Investment Officer at Ranger Investment Management, is here. We're talking small and microcap stocks. It's time for the market call. Welcome to the Money Life Market Call, the part of the show where we talk with experienced money managers about how they do their job, what they look for that determines their buys and sells, what they see happening broadly on the market, and how they are putting it all together. Joining me again today, Conrad Doenges. He is Chief Investment Officer at Ranger Investment Management, which runs the Ranger Small Cap and Ranger Microcap funds. That's RFISX and RFIMX if you're looking for the ticker symbols. But if you're looking for more information on the firm, its funds, or Conrad, go to rangerinvestments.com. Conrad Doenges, welcome back to Money Life.
Thank you, Chuck. It's great to talk with you again. Always a pleasure.
We always start with methodology. So obviously, small and microcap is your focus, but what makes things stand out to you? And also, what's making them stand out now when we've had a market that has been so dominated by the large caps that the small caps and micros haven't necessarily participated in this rally, which puts them all in like the same territory and harder for one or two to stand out, doesn't it?
You nailed it. No, just first, real quickly, a reminder of our investment process and philosophy. We're a concentrated, research-driven, small and micro-cap growth manager. We're bottoms up, fundamentals first, very repeatable process with a very disciplined portfolio construction and daily, risk management oversight. We focus on quality growth businesses with recurring revenue, durable competitive advantages, strong free cash flow, and management teams that allocate their capital prudently. We don't try to be macro guys because you're, right or wrong half the time, but we use the macro to stress test portfolios rather than time markets. As you mentioned, it's been an interesting period, the domination of large caps. For 3 years, we've been in a market environment where performance has been concentrated amongst the well-known Mag 7 companies. This performance has been justified as these companies have delivered on earnings growth. Other market leadership over this period of time has been more speculative, whether it be, Bitcoin mining, nuclear, vertical takeoff taxis, quantum, meme stocks, or in the most heavily shorted names. So as far as quality growth, we sort of feel like we've been left at the starting line over this period of time. Further to your point, small and micro caps have materially underperformed large caps. And the reason is really straightforward. As an asset class, if you look at the Russell 2000 as the proxy, earnings growth has leaked away over the past 3 years. Higher rates and an unsynchronized business cycle post-COVID are the main culprits. Each time we get an economic data point that leads to investors to think that there's going to be a rate cut, small caps will broadly rally, but then falter. Just for frame of reference, if we just look back over the last 3 years, at the start of 2023, the Russell 2000 was expected to grow earnings 8%. They declined 10%. At the start of 24, earnings growth was estimated to be 23%. They declined 12%. 2025, we started with estimates of up 35%. They're now up 18%. So we're not negative. But once again, this trend of leaking away has not helped the asset class one bit. That's why you just don't have asset flows that have helped, drive performance broadly amongst the entire group. So the only thing that we've had as a positive for the past 3 years, and this is not really one, is that we're working off of a smaller denominator. And you don't want to hang your hat off of that. So I do think that there is now right in front of us a tangible catalyst that's not just a lower denominator for there to be sustained outperformance by small caps. And that rests with some tax provisions in the One Big Beautiful Act. And you've had many controversial provisions or parts of, highly debated parts of the act, but the full expensing of capital investment in machinery, equipment, and structures, which allows companies to immediately deduct 100% of their qualified purchases, is a huge incentive to accelerate investment in production capacity. And that's, that is something I can hang my hat on. As we look forward, I believe we're finally at that point where, just as we were in 2017 with the prior Trump administration with the favorable tax provisions for the asset class to work.
In there as well, there was a lot of talk that small caps would be hurt more than large caps as we've gotten into the tariff regime. The tariff regime was part one of the administration's plan. Deregulation is part two. You're talking about the stuff in the bill that has the potential to help small caps, but are you also thinking, especially since you are bottoms up, are you identifying now some companies that you think will be, maybe call them a deregulation play? Obviously for you as a small cap investor, it's just they're looking at better times. But for anybody who's looking at them, do they become deregulation plays because a small cap company, more than a large cap company, maybe pays the burden of compliance? I have a smaller business to amortize that out over. So is there a small cap boost coming if we see the deregulation that's been promised?
We agree completely that there is. I mean, thematically, we made investments in both Lazard and Perella Weinberg at the start of the year, based on what we think is, the favorable deregulation. And we're now starting, to see that the IPO market is opening up, and that will serve as a catalyst. One thing that is a striking statistic, particularly in our microcap portfolio, is that over the years, 25% of the companies that we've owned have been bought out. And in the Biden administration, you couldn't get anything past the regulators. And now, we're seeing record closes amongst banks that are making acquisitions. And so we have some regional bank exposure, Home Bank, Bank OZK, Business First. And these companies have historically been acquisitive. We have too many banks in this country, and the smaller ones just can't compete. And so there's a real prime market for those larger small caps to, buy the fill in niche markets, particularly in favorable geographies. And so, yes, we think that deregulation is and will be a powerful catalyst for the next couple of years.
Will microcaps benefit as well? Can microcaps become sort of a market force again? Because they used to be, admittedly, on the small side of what you were going to get. But as we've watched cap sizes change, the way they calculate cap sizes, the way they calculate what's large cap or mega cap, et cetera, there are very few large cap companies, relatively speaking. But as they keep pushing it down, does that make it harder for microcaps as a group to rise up? You can have the company here or there, but as an asset class, are they less effective in this environment?
There's always a reversion to the mean. I've been doing this for 35 years, and small caps have today represent about 3.5% of the total market value of the US market. That's back to 1930s levels. Average is about 7.5%. So it's going to take a lot of lifting to get it back to there for it to be meaningful. But the concentration of performance, like I said earlier, right, justifiable. Once things broaden out, and when I say this is favorable for small caps, it's favorable for mid caps, it's favorable for smaller large caps to have the market have broader participation and performance. And you could see headline numbers of the indices be way down just because the companies that have driven the performance come down to more, to lower valuations, while everything else underneath the hood is performing well.
You mentioned a name or two in there, but is there another company that for you is kind of a poster child, an exemplar of the methodology, the kind of thing you wish people were finding in the small cap and micro cap space?
They're bountiful. One that is a name that is owned in both our small and micro cap portfolios is a company called One Spa World. They're the dominant operator of spas on cruise ships. Symbol OSW. It's the old Steiner Leisure, if people have any historic knowledge on the industry. The company basically went out of business because of COVID. No ships were sailing. Nobody wanted to be on one. They were bought very smartly by private equities management that was at Steiner, came over. They had a lot of debt when they came back public in 20. And as an operator of spas on ships, they have no capital expenditures. That's done by the cruise ship operators. So this is a cash flow machine. Essentially, they're a logistics company. Their job is to make sure that you have people that can do facials, massages, whatever for, each, for all the ships around the globe, and have that coordinated for the 6-month terms that, the people are on the ship. And as I said, I think it's 200 plus cruise ships that they operate on, and they have 90+% market share. They've been growing their earnings. They had a big explosion obviously post COVID, but it's a 15-20% grower easily in earnings. You have more ships coming online. It doesn't trade at a stretched multiple. Very clean. They paid down basically all the debt, and all they have left to do now, because they don't have any capex, is buy back stock or give a dividends.
So again, that's ticker symbol OSW. Very quickly, when you find something like that, what ultimately makes you sell? Obviously, as you pointed out, in a lot of cases, you're selling because the company's been purchased. But when you find the right kind of thing, what is it that makes you give up on the dream?
Always there's something that could change fundamentally, and that is thesis challenging. And, we try to obviously avoid those. The other would be, moving on from market cap, depending on the size of the company. One spa is a little over a 2 billion market cap. So it still fits very neatly into our small and micro cap portfolios. We found that valuation, you can outsmart yourself a little bit by trying to trade too much around valuation. But when you get a move that is parabolic in a name, we have a discipline of cutting that position to more reasonable size. And then obviously a competitive threat that comes in that challenges the thesis that wasn't originally thought to be one. We have AI, and we're working through all of the ramifications that that's going to have on SaaS companies, and that's a great unknown. Software is trading at very low valuations. You're intrigued by them because they're cheap, but you don't quite understand or have a clear picture of what the competitive threat is from AI right now.
Well, now that we've got an idea of how it all works, we're going to put you to the test of our audience.
Quick and dirty.
I love to get small.
Yeah, we do like to get small. We're talking small caps and really small caps, micro caps, with Conrad Doenges, the Chief Investment Officer at Ranger Investment Management, runs the Ranger Small Cap RFISX and Ranger Micro Cap RFIMX. Learn more at Ranger Investments. You know how quick and dirty works. It's our lightning round. We're going to jump straight in. And we start today with a request from Tony in Henderson, Nevada. He wants to know about Lemaitre Vascular. It is ticker LMAT.
Company that we've owned since 2017. They're a pure play provider of vascular surgery devices. Very founder-led, great margins, growth well balanced. We see it, it's been a very consistent performer. I think most importantly of late, the company's strategy of going direct with sales instead of a reliance on distributors has really been of benefit to them. So it's a buy.
I'm in this for the long haul.
That's a long-term buy because he's been in it for about 8 years now on LMAT, Lemaitre Vascular. Richard in Chula Vista, California gets our next request. It's for Aon, AAON, the name of the company, also the ticker symbol.
Aon, another name that we've owned for about a little over a year in our small cap portfolio. They're a premium HVAC equipment manufacturer, domestically based. Just opened a big new production facility in Memphis. They've been benefiting from an acquisition that they made a couple of years ago that has, gives them a strong presence in the AI data center business. However, they've been implementing an ERP system that has made numbers very noisy near term. If you're a long-term investor, I'd use weakness as a buy. They have always consistently performed and executed. It's just a few hiccups here with the recent results, well managed and trading at a very attractive valuation versus itself historically.
So it sounds like you want to wait to see a couple of things do that. You're holding it if you've got it.
Yep.
And you're looking for the opportunity to buy some more.
I'm just taking my time before making the move.
On Aon, AAON. Tom in Smithfield, Kentucky wants to know about Wendy's. Hard to believe a company that well known as a small cap, but it is, and it's WEN.
Wendy's, we just went and saw them 2 weeks ago. There's a leadership vacuum. Their former CEO left abruptly for another opportunity. And the current CFO, who's only been with the company since December and doesn't have a restaurant background, is the interim CEO. They're competing in the fast food wars, and McDonald's is tough to beat. Their franchisees have they don't have consistent performance across them. We think it's a sell. I guess you'd say, where's the beef?
Where's the beef?
That's exactly what I'd say. And if that's what you're saying about Wendy's,
Where's the beef?
it's a sell on WEN. Our last two requests today come from Lance in Bethlehem, Pennsylvania. The first is for Builders First Source, BLDR.
Builders First Source, a good company, a leading supplier of structural building products, as well as installation and framing services. We prefer another company with similar exposure, Simpson Manufacturing, symbol SSD. Same in-market exposure, but what we like from it is that it has less commodity exposure. BLDR has more direct lumber price exposure, while Simpson's products are specialized, giving them some better pricing power with much lower direct commodity pass-through. You can see this in the margin profiles of the two companies. BLDR has a low 30% gross margin and low teens EBITDA margin. Simpson has a 46% gross margin, mid-20s EBITDA margin. It's a less competitive environment, and you're only paying a modest premium for those better performance numbers. Simpson trades at 14 times forward EBITDA versus 12 at BLDR.
So BLDR, Builders First Source.
Sell it. Just say, I'm selling.
Yeah, but not because it's a bad company. It's just good company, bad stock, especially in this case when compared to Simpson Manufacturing, SSD.
When you buy here, it's going up.
And last, again for Lance in Bethlehem, in the limited time we have left, Green Brick Partners, GRBK.
I'll be real quick. It's a company that we've owned since December of 2015. So long-term investor, shows much of our process there. They're Dallas-based. They have a strong presence in this market, Atlanta. They're expanding into Houston, which we think it will be a big growth driver. Very well managed. We think we've reached the peak of having to offer incentives on homes. And today, mortgage rates hit a 1-year low of 6.5%. Buy.
And so we finish on a high note.
Winner, winner, chicken dinner.
Yep, that's buy on GRBK, Green Brick Partners. And speaking of goodbyes, now it's time where we have to say our goodbyes to Conrad Doenges. But Conrad, this was great. Always appreciate getting a chance to hear about small and micro caps. Thanks for joining me again on Money Life.
You're welcome. Great to be here, Chuck.
Conrad Doenges is Chief Investment Officer at Ranger Investment Management. They run the Ranger Small Cap and Ranger Micro Cap funds. Learn more about them at rangerinvestments.com. We'll come back in a moment to put a bow on this show, so don't stop now or you just won't reach the finish line, and that won't be satisfying at all.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
We are back to wrap things up, and it's easy to do when you have a small cap manager because you generally don't have crossover, right? You're going to have lots of crossover when you're dealing with mega cap guys, when you're dealing with large cap guys. I mean, again, if you go back to what Bill Nygren was saying 6 months ago on this show, where he said there's only 20 large cap growth stocks left. Well, if you have a large cap growth manager, you got a pretty good odds of hitting something over and over again. But if you have small and micro cap stocks, yep, we might talk about them one time and we may never talk about them again. It doesn't mean you shouldn't send me your favorite picks. It really doesn't. It's just you have to understand that certain things are harder to get off the list. It also means that we're always looking to get them off. And sometimes, even when we're dealing with a manager who tends to focus on small caps or what have you, they will want to make a statement because they have a strong opinion about something like an NVIDIA, where, yes, it's the biggest stock right now, but they've got something that, is a bee in their bonnet and they want to be able to get it out there. So by now you should know, of course, I am traveling this week. So everything that you heard yesterday and today pre-recorded. Tomorrow, not so much, because today I'll be traveling from Raleigh, where my daughters live, to Portland for FinCon. I don't entirely know what we've got coming on tomorrow's show. I know most of it, but I reserve the right to change my mind about some things because it is possible that I'll connect with some people on Tuesday before the conference starts and grab an interview or two. But I do know that Jillian Johnsrud, who will be at the conference, well, I'm not talking to her there. Her new book, Retire Often, a fascinating discussion. And I know that there are several of you who are thinking about retiring overseas. You definitely want to hear this interview because of something that's in there that she talks about. But she's coming tomorrow. Chuck Carlson from Horizon Investment Services will be back answering this great question I got about dividend reinvestment plans. And Chuck's like, do people write you this long a note all the time? No, most don't. But again, when you send us a question, it could be one-liner or it could be one long story. We've got a long question that I think is really good for people to hear. So we've got those two things for sure. The rest of it, you'll have to check it out to see what we've got. And then the rest of the week will all be from FinCon. Meanwhile, if you are looking for something to celebrate, well, it's National Teddy Bear Day. And then, as if teddy bears weren't enough, it's Care Bears Share Your Care Day. So I guess Care Bears are also Teddy Bear Day, but we had to give them something special.
Well, isn't that special?
Well, yeah, Teddy Bear Day should be special, so it's the Care Bears holiday.
Well, isn't that extra special?
Apparently so. It's also Wonderful Weirdos Day.
Never trust a weirdo.
And on the food front, it's National Ants on a Log Day, celery with peanut butter and raisins. And yeah, that's never been my thing. but it's National Wiener Schnitzel Day. And yeah, that is definitely my thing. In fact, it's the first thing I ever learned how to cook. You've heard me talk all the time about food. I make fabulous schnitzel, and I will be making schnitzel not with veal, but with chicken while I'm down visiting my daughter, because although they can all make it, it was one of the first things I taught them how to cook. They still like it when I do it. We're going to try to make some food for Whitney and Greg and baby Declan, although he won't be eating the food for the next couple of weeks. So we'll be making some schnitzel that they can use in chicken parm and other things moving forward. But yeah, I love schnitzel, and I have made it for a long time. And if you need advice from somebody who is really experienced and does it well, I'll share. I'm happy to share my recipes. Meanwhile, my guests today were Jeff Patak, Managing Director at Morningstar Research Services, Morningstar.com, the direct link to the story we talked about. Allison Hadley from Digital Third Coast on the mid-year tariff study from bidonequipment.com. And then Conrad Doenges, Chief Investment Officer at Ranger Investment Management, rangerinvestments.com. Thanks to them. Thanks, of course, to Rob Floyd, my producer. Thanks to Maho, my dog, who let me get all this done while I was trying to get away. But mostly thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from David Swenson, who said, as a general rule of thumb, the more complexity in a Wall Street creation, the further and faster investors should run. Yeah, I agree with that. You don't necessarily need complexity. Simplicity works great. And if you want to keep things simple, don't just do it when it comes to your investments. Do it when it comes to your investing. And remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Road trip! Road